All right, good afternoon, everyone. I want to thank everybody today for joining us. And before we get started, I do just have a quick word from our legal friends that I'd like to advise everyone on the call that this will be recorded and that all participants will be muted upon entry. I'd also like to remind listeners that management's prepared remarks today will contain forward-looking statements which are subject to risks and uncertainties. The information presented on this call is management's best estimation based on current information. However, actual results may differ materially from management's current expectations. And with that, I'd like to introduce today's speakers. We're going to have myself, Gabriel Millard, SVP of Capital Markets, as well as Jason Jogia, Chief Investment Officer for the Avenue Living Group, as well as Anthony Giuffre, the Founder, CEO, and Executive Chairman for the Avenue Living Group. And with that, I'd like to pass it off to Anthony to kick us off.
Thank you, Gabe. On behalf of myself and senior management, would like to welcome everybody to Avenue Living Core Trust Investor Call for the August 2022. I'd like to open the call, obviously, in looking at kind of our economic environment, some of the headwinds that we're currently faced with when we look at the news and the news cycle right now, talking about inflation, talking about housing affordability, talking about rising costs. And what's really interesting for us is today is a Wednesday. These things that we've been dealing with as every Wednesday for Avenue Living. When we think of our beginnings, they're truly humble. We started this business, obviously, at a very micro level with 24 units. This year we'll probably cross over 15,000 units under ownership and operation. And really, it's been 16 years of an entrepreneurial journey. But throughout that entrepreneurial journey, really what we have developed is a true scrappy ethos, which has allowed us to really build out what we deem as a very robust and nearly bulletproof operating platform. If we look back, a few years, we've managed through a pandemic, we've managed through the global financial crisis, the commodity meltdowns, obviously very much polarized to the prairies, and really a changing working and living environment for not only our employees, but also the folks that live with us, which is almost 30,000 strong. And really what we've done today, as every other day as we've operated this business, albeit we're now more sophisticated, is we've stuck to our knitting, we've stuck to the same business plan, and we've really stuck to low density multifamily. Albeit the communities that we buy and that we now operate that certainly have moved from, the very humble ones of the 24 suiters that we started with to now whereby we're buying communities 300, 400, 500 units strong. Really, it's operating under the same premise to provide the customer with quality rental housing, quiet and peaceful enjoyment of where they have their shelter, and to be able to essentially operate as efficiently and as profitably as we possibly can. And what we have seen when we think about the actual past few years is really, how did we get there? Really, what we've done is we've recognized in order for us to be an effective business, we needed to out-operate our peers. We needed to out-operate, the previous owners, whoever we're aggregating assets from. And what it's allowed us to do is to create, we know that low density multifamily, as we've determined, as we've called it, workforce housing, it's deemed in the marketplace as a very defensible asset class. We have provided, or we have created, institutional style property management to make this an extremely defensible asset class, but an operating class or operating platform that can manage through obviously any headwind that we've seen. And as mentioned previous, we've seen nearly every headwind imaginable in the growing of this business. And just to take a quick moment down memory lane or history, obviously we had an outside-in strategy. We focused on secondary and tertiary markets. As we gathered momentum, as we gathered AUM, we started working our way more and more into the major markets. And as a result, we've now moved to approximately 65-35 in terms of major markets to secondary markets in our overall asset base and offering. And how have we done this? Essentially, again, focusing on the customer. slowly but surely improving assets to near new, their original formats, their original capex in terms of how they were built, how they were meant to operate. We've done that very effectively, and as a result, really trying to define ourselves uniquely as an offering. We've done that well, and as a result, and over the course of the last 2 years, through the pandemic, we've recognized some of the best-in-class management styles or offerings that we've been able to do to take our platform to the next level. When now, over the course of the last few quarters, what we've seen in terms of some very disruptive geopolitical environments, maybe the swing back to certain commodities being in favor, we're now seeing that we, in the prairies where we're mostly concentrated, we have an opportunity to effectively enjoy what we'll call a bull run. And what do I mean by that? Those inflationary pressures are continuing to allow us to increase our rents and trade outs, both on a renewal basis and new residents or new customers, but also allowing us, obviously, to gain the benefit of net inbound migration, whether that would be intra-provincial or from other countries. And as a result, what we are seeing is occupancy buoyancy higher than we've ever seen in the history of the organization. Vacancy is tightening, and in fact, as of this morning, we have over 200 of our buildings have wait lists, which for us is unprecedented. As a result, with that upward pressure, we are able to see anywhere between 10 and 15% organic growth. Really, essentially, when we're looking at the end of every single month, it's allowing our operating revenues to move up between 80 and 120 bips month over month. So when we're looking at that, we're looking at a 1% revenue rise month over month, quarter over quarter, and we see that for the foreseeable future. Over the past few years, as mentioned, we've been building a platform. We've been buying, we've been investing in Alberta, we've been investing in Saskatchewan. We've also been investing in the flyover states in the United States as we've been preparing ourselves to enter those markets. And as a result, what we are seeing is through all sorts of uncertain times, our operating results continue to rise, and we're continuing to show how to essentially operate this business as a best-in-class operator. So we're very excited. What we try and do to ensure that is, again, focusing on the customer needs, but also focusing on things like capital expenditures, ensuring obviously that there's a certain percentage of our AUM gets recaptured back into investing in our buildings to ensure, number one, that we maintain an ESG focus. We again remove or eliminate over time the significance of our carbon footprint, but also really ensure that we become more efficient and a more customer-friendly operator. In doing that, essentially, we've won the hearts and minds of our customers. We've also obviously maintained and continued to grow increased credibility from institutions like the Canadian Infrastructure Bank, CMHC, and lenders alike. As a result, our offering again sits at the forefront of multifamily offerings within Canada. This year, we've purchased over 1,300 doors in 2022 and have achieved a scale of over 14,000 in our core trust alone. Buy-side opportunities continue to arrive on the market. We essentially saw what we called in previous calls a changing of the guard. We're seeing older operators coming in and saying they might be looking for liquidity events. They obviously might not necessarily want to adapt to the changing marketplace. They might be concerned about whether it be geopolitical and or inflation costs or rising cost of debt or changing demographics. We are there. We actually built a platform that we have the ability to continue to grow our platform profitably, not for the sake of, but we're not going to buy for the sake of buying, but really based on our operating advantage, really see the opportunity to continue to grow our platform. Because historically, over the last 16 years, we've been through, we've learned the ropes, we've learned how to do this thing effectively. And as a result, through uncertainty, through those headwinds, as mentioned previously, we feel that there's never been a better opportunity to double down, be that great operator, and really look for opportunities as we're starting to see some uncertainty economically, as well as geopolitically. And I think in terms of that, our timing is very good. How essentially do we get there? Well, we're being careful in terms of for the actual acquisitions, in terms of obviously maintaining ample liquidity, but really assessing how we can provide or bring value to our organization. And how we bring value is we look at things based on performance pillars, whether we're looking at it globally as an overall portfolio, or whether we're looking at a single asset within our portfolio. There's 3 specific drivers that allow us to determine whether or not we acquire, or essentially from a dashboard, a benchmark, how an individual building is doing within our overall portfolio. And essentially those performance pillars, can we be performance focused? Obviously the customer first approach in our decision making obviously allows us not only to aspire to be the best that we can be in terms of workforce housing, but really to ensure that we have that longevity of the tenancy. That workforce housing population is the largest segment, and we want to make sure obviously that we decrease our number of tenant turns or resident or customer turns to ensure obviously we can optimize the revenue within that particular suite, within that particular asset, within the global portfolio. The other thing that we try and do is when we're looking at assets, whether a future asset or one that we own, is do we have the ability, or are we vertically integrating all of the management process end to end within that particular asset? And essentially we want to make sure that we are a full service asset manager and property manager. So essentially as the second largest building owner in Canada, we recognize that we manage, foot high and a mile deep, or foot high and a mile wide, so to speak. And we want to ensure that whatever we do, we have to do it with great levels of efficiency. When we look at our portfolio, we want to look for what we call heat spots every single day to ensure all of our assets are operating as they need to ensure obviously that we've created that highest level of efficiency to support both yields and NOI, and ensure obviously that our labor dollars are being put to its highest and best use. And obviously the other thing that we want to always be focused on in one of the pillars is being strategically diversified. That's very important. As mentioned, second largest building owner in Canada, 450 properties. And so from what we want to make sure, and obviously we've seen it, is how do we buy well? How do we protect ourselves from obviously whether it would be transitory headwinds in terms of geopolitical, inflation, commodities? How do we do that effectively? And how we're doing that effectively is by maintaining what we deem as decent market segmentation, finding areas within the market that whereby we'll call it their sector proof, whereby should we see some level of a slow economic slowdown, we're not seeing that transitory flow out of a market or into a market. So relatively no peaks and valleys, but obviously a stabilized workforce housing population that ensures greater operational success. So what we feel is we have an ongoing strategy with our existing product that actually makes sense. We see some great opportunities as we continue to sophisticate, look for larger opportunities, and really we're going to do the same thing today that we've been doing, regardless of headwinds in terms of inflation, whether we're seeing an oncoming recession, whether we see larger migration or inflows or pressure on housing affordability, we will continue to operate the same way, build upon it, and become more efficient. Now, the two presenters today, both Jason Jogia, our CIO, and Gabriel Millard, who is our Senior Vice President of Capital Markets, they're going to take you down a quantitative and qualitative analysis and discussion in terms of what we have done thus far, some of our guiding principles, our KPIs, and some financial metrics, which will really drive this point home to basically say, where have we been, where are we, and where are we going? So on that, I'm going to pass it off to Jason Jogia, who will focus on this next part of our discussion.
Thank you very much, Anthony, and thank you everybody for joining the call today. In terms of our drivers of success and what's allowed us to flourish during these times, to Anthony's point, just to deep dive a little bit more into this, our customer focus really focuses on the resident spectrum. And if we really think about renters on the scale of a spectrum, Avenue Living has built a business model surrounding the workforce housing customer. And that's really somebody who is overqualified for affordable housing, but yet aren't able to afford home ownership or an average market home for purchase, or maybe even for rent. And as a result, this demographic is proven to be a bit of a renter by necessity in that moment in time. The income of the household of this demographic typically ranges between $15 to $50 an hour. And really what we have done is focused our asset selection on this tenant profile. So we don't typically buy the shiny, bright new in a downtown core where the rents need to be somewhere north of $4 a foot to sustain value economics. We're looking for that medium density community, maybe close to the core, maybe in a suburban setting of a primary market or secondary market, that enables us to deliver quality institutional operational service while ensuring that the costs stay within the affordability construct, which is generally indexed at 30% of household income. And with this demographic, what we've recognized is that it's a diversified employment base. And so to Anthony's point of us choosing asset-specific allocations in various geographies to ensure that there's diversification within the tenant profile, there's no one single industry or one single correlative employer that is servicing this tenant. And as a result, we see that diversification in the portfolio of cash flows that we receive through revenue generation. And when we hone in our operations around this customer, what we've really done to provide them that institutional quality service typically starts with the branding and the image of the building, works its way into the capital expenditure on the building, the street to suite aesthetic, then the standard of the suite that they live in. But once they're in, and once they've gotten past the front door, and once they're in their suite, it comes down to the comfort of the resident's experience. And really what we do is commit to provide certain service standards that enables them to have a best-in-class living experience at a cost construct that would arguably continue to sustain the test of time from an affordability standpoint. And some of those things include things like our work order commitments, where within 72 hours, we are guaranteeing to service any work order related issues within a unit. And our compliance rate on that is 99% at 24 hours. So you can tell that we're very much ahead of this, whether it be enhanced pest mitigation strategies, whether it be enhanced safety strategies, and then also looking at that sense of community. So whether it be the social media, the community boards, the branding of our vehicles, the branding of our uniforms, a person living in an Avenue Living building knows they're in an Avenue Living building. The other part is trying to make their life easier, whether we provide them utility programs at a margin, parking programs, pet programs, ancillary revenues such as vending machines and things. These are some low frills items that allow them to have a better living experience, but also enhance the margin of the business overall. And essentially the resident support come from things like a 24-hour call center. So, in a typical building of medium density, these types of amenities don't readily exist. These amenities exist in towers in a downtown urban setting that we've now brought to suburban sprawl. The other piece is the vertical integration, from the acquisition and investment all the way to the operations to the ongoing management of the asset. We've really focused on ensuring that we've got everything in-house that we can control. So we really focus on finding the right assets for the customer that can be efficiently managed within our vertically integrated platform. And by buying assets below replacement costs, consolidating fragmented ownership, and then internalizing the operations and adding that CapEx component with the active management style, we're able to create a strategy of sustainability around holding these assets in our portfolio and accumulating the regeneration ability of the cash flow. And that's because, again, we're in control of the full value chain surrounding our business. Other kind of prioritizations have been, some of our strategic partnerships, whether we talk about our fintech platform known as Zenbase, which is a buy now, pay later product that sits in our ethos to be able to support our tenants. This is something that we used to do manually. One of the first in industry to work with our residents to give them weekly payment options. We've now digitized it and made it an automated system that sits within Avenue Living. Whether we have, the back office software and paperless software such as Yardi and Yuhu, our strategic supply chain partnership with Home Depot to ensure that we're able to consistently have supply chain, even through some of the most turbulent inflationary supply chain disruptive times, allows us to ensure that our residents get a consistent delivery of product and service, and then also creating uniformity in our service standard. Beyond the brand of the building, beyond the brand of the asset, beyond the CapEx, having our staff trained through the Disney Institute has been very, very fulsome in terms of creating that review and that cycle and that sentiment of our customers to ensure that they're satisfied with our service, and actually has allowed us to have very strong net promoter scores, very strong Google reviews, and probably some of the best relative to our peers in our industry. Thought leadership has been one of the things that we've really focused in on through our lens. If we look at workforce housing as a subsection of housing within Canada, that is a very defined and known term in industry within the context of the United States. But within Canada, what we recognized years ago is that it was very under-researched and not really understood. Avenue has put a lot of effort in putting out white papers, articles, blogs, etc., to share thoughts of our industry, our segmentation, and to be at the forefront of educating our stakeholders with one voice around the industry itself and our subsection of it. I mean, even to the point where our founder Anthony did a co-authoring of a white paper on the rental spectrum that was recently published in the International Real Estate Review. Strategic diversification is something that Anthony touched on, and really for us, diversification has 3 pillars to it. Number one, no one building should create enough systematic risk within our organization to cause a challenge. And as a result, we have a diversified asset base with over 450 properties. Above and beyond that, we would have over 20 geographic markets that we participate in. Primaries, secondaries, tertiaries, most of our weighting now towards that primary side of things. However, having that diversification of geography and customer and asset enables us to avoid shifts and create defensibility within our asset pool. And then I think the other piece of that that's critical is the capital base, making sure that our capital is funneled through multiple channels and multiple conduits, many of them on this call today, to really ensure that the business has all the formula to thrive through volatility, which in the 16-year existence, it's managed to do so very, very well over the years. Initiatives around Avenue Living have really been around ensuring that when we select assets, there's a level of conformity and continuity. And if I look at those pictures that Dave just had on the screen, that's the type of low density assets that we really focus in on. And you can see that there's some definite uniformity in how we buy and what we buy. Moving on to dynamic initiatives, really ESG has been a focal point of our organization. Taking through environmental, social, and governance, and some really interesting examples. I mean, whether we look at our environmental impact, and I'll give you a couple more examples in a minute, but regarding our recent partnership that we announced with the Canadian Infrastructure Bank, looking at the social impact of the residents we serve, the number of NGO organizations that we work with to create support, the fact that our call center can operate in 30 different languages, it really does focus and put the emphasis on that social impact for our residents. And then our governance, running our organization like a publicly traded company, ensuring that our reporting is forefront and ensuring that we have the right independence to manage any conflicts of interest throughout our organization. That in itself creates the idea of the triple bottom line, which is very important to the organization. And through the examples that we have here, the Canadian Infrastructure Bank partnership that I mentioned It's really, really exciting for the organization. So for the last couple of years, not only have we been working with the infrastructure bank, but we have been trailblazing to create policy to enable large scale landlords to borrow to improve the GHG emissions or reduce the GHG emissions of housing, multifamily housing. And the idea around it is the fact that if we look at the apartment universe in Canada, there would be over 2.5 million individual units in the primary apartment universe. 90% of that platform has been built prior to the year 2000. And I would say that 80% of that would be low density, medium density asset types that are akin to what Avenue Living owns and operates on a day-to-day basis. Our ability to take those units to model in deep energy retrofits such as solar, envelope upgrades, better windows and doors for insulation and our values, heating and mechanical upgrades for efficiency, as well as some prop tech and Internet of Things technology, it really enhances the opportunity to reduce GHG emission consumption and suddenly changes the product of these assets. And over the 2-year journey with the Canadian Infrastructure Bank, it was very important for us to make sure that if we were going to take the impact to have an environmental betterment of our assets, it would have to come with the financial feasibility. And what's really exciting about this is that the incremental investment in the assets pays for themselves over a whole period through simple consumption reductions and simply accelerations of long-term maintenance capital expenditure. So a very exciting project. 6,800 doors or 220 structures will be touched over the next few years, and that would be phase 1 of this project, which will now then lead into phase 2, which will be the rest of our portfolio. And, you know, again, we're open source, so we're very much open for the CIB and Avenue Living to share our findings with the industry as a whole to encourage this level of initiative within the industry. So why is all this important in terms of these drivers, our thought leadership, and our strategic initiatives? Because multi-family has always been touted as a hedge to inflation. For long before Avenue Living's existence, it's always been looked at as one of the best and safest asset classes to invest in, especially during inflationary times, especially during volatile times. And really, when we look at Avenue Living as a whole, we're seeing that we are having exposure in our labor rates, in our material costs and utilities and taxes, and even in interest rates to a moderate degree. But what's really interesting is that because of the fact that multifamily has leases that are 12-month in nature, and we operate in low to low rent control environments, we have the ability to flow through cost creep actively in order to hedge against current and forecasted inflationary pressure. And so if we look at an average resident in an Avenue Living, I mean, typically rising tides tend to float all boats. And when we think about minimum wage, I mean, in Alberta alone being set at 15, but a job right now can't be filled for less than $17.50, our average customer currently is making over $53,000 in household income at the Avenue Living portfolio. Our current rents amount to approximately 23% of their income. Affordability is defined at 30%. So when we're asking that customer for a revenue increase through a renewal, 12 to 15%, we know that that still remains within their affordability construct and that we're being socially responsible to flow through that trade-off. And that's what's driving this accretive organic same-store revenue growth that Anthony mentioned of 100 basis points a month. And it's allowing us to hedge against the inflationary pressures that we're seeing. And then to add to that, multifamily, fortunately, benefits from longer term leases that exceed the average lease duration. So for instance, our fixed term debt today would have an average duration of over 4 years, while a typical lease would have only 12 months. So we have 4 renewal cycles to ensure that we can hedge against any inflationary pressure on interest rate risk. That also gets bolstered by the fact that Avenue has tier 1 status or large cap status with organizations like CMHC, Freddie, and Fannie to get preferential pricing and credit spreads and better credit ratings in order to reduce and monitor and maintain that cost of debt at a great rate. So between our supply chain, between the low to no rent control markets and our active treasury management, we're very, very well situated to increase our rents live in play to be reactionary and proactive to inflationary and interest rate creep pressures. But there's one secret sauce to that, and that is that we need to make sure that when we put pressure on our customer, that they believe in the brand and the operations and the continuity of our service delivery, that they're willing to pay the premium to live with us. And what we found resounding through this year, through the pressures that we've been facing, through the pandemic and through historical operations, that people choose to live with Avenue Living. And as a result, we are seeing unprecedented growth rates. We're seeing a bull run happening in our midst. And ultimately, I get asked this question quite often, well, what happens to value? Well, while cost of capital goes up, the growth rate is also going up. And as a result, we typically are seeing growth outstrip the increase in cost of capital. And that enables us to maintain, if not increase, valuation during these times of uncertainty. And this is, based not just on the Avenue Living viewpoint, but the market as a whole lens, where we have been managing to not just keep up with the inflationary pressure of our peers, but outstrip them and outpace them over this period of time. So with that, I will now hand it over to Gabe, who will focus on financial performance of the organization. And I thank everybody for their time today.
Perfect. Thanks, Jason. And thanks, Anthony. So today, we've talked about a lot of the exciting things that have been happening really since the start of Avenue and over the first half of 2022. But what I'd like to dive into is really some of the hard numbers and what does this all mean in terms and translate to for Avenue. So we'll start out with this table here, and we can just kind of take the columns left to right and discuss, what we've seen throughout the first part of the year. So we've seen that Avenue's acquired. We actually have maintained a pretty strong, especially at the beginning of the year in Q1, acquisition program. Over 1,300 units have been acquired so far in 2022 for a total purchase price of approximately $240 million. We've seen very strong quarterly revenue growth, both on a total basis as well as a revenue per owned door basis, which we'll double click on in the next slides coming up here. Our stabilized occupancy is something that remains very high, even though we're seeing a compressing in terms of the number of units coming online. The market is absorbing those units. And what's really exciting is you heard both Anthony and Jason mention that, we're seeing lease trade outs within that 10, 12, 15% range, yet maintaining our occupancy at extraordinarily high levels. So it's showcasing that the market is really accepting our new offering, and a lot of the CapEx work that we've done over the past few years is really starting to see the benefits of all of that. Also on the NOI margin, our operational efficiency, the size, scale, scope of the operating platform is really starting to come to fruition. So despite some inflationary pressures within our capital costs, we're still seeing improved NOI margin as those rent increases are outstripping any of the costs coming up that we're seeing in terms of supply chain issues, as well as then the size and scale that we're able to acquire. The more units spread over a similar operating base is really starting to come to fruition. And again, we'll double click on the NOI margin and our NOI in the next couple of slides here. We are also now, as you can see, the proud stewards of over $1.1 billion in equity, which is something that we take very seriously and are very proud and appreciate all of the support that everyone on the call has provided to us. As mentioned, our CapEx program remains robust. We've seen this happen throughout over the last 3 to 4 years. We've really been able on a very strong CapEx program. We're really seeing the results from that. What's exciting is that the CapEx, even though we're continuing to invest hard dollars into the assets, we're continuing to acquire new assets and invest more CapEx into that, continuing to improve our operations as a percentage of our overall AUM. We're starting to see that continuing to decline in the same way that it's being spread over a larger equity base. As well as then the other pieces, if you provide a solid place to live and a solid operations, a solid business, your customers or your residents are happy to pay, and we're seeing a continuous increase in our spot rent collections. We hear a lot in the industry since COVID about, rent collection, and our people are going to be paying, and what is happening with real wages and real incomes across the market. And we're seeing here at Avenue that, people are wanting to pay and they're wanting to continue to help support our service. So that's something that, we're very proud of seeing. Now diving into a little bit more onto the revenue. What we're seeing here on the left-hand side is a very aggressive revenue growth chart since the start of 2019. We've been very active on our acquisition program, acquiring and high-grading our portfolio and really accretive acquisitions. And then especially even over the last year, we've seen just under 70% year-over-year increase in our monthly revenue. But what's really exciting is the chart on the left, and we've talked about this in past presentations and past updates. But this is the revenue per own door number, and really what this is taking your total revenue and you're dividing it over your entire asset base. It's a number similar to what's used in the hotel industry, and what it really ensures and why we like to track it is to make sure that we are optimizing both our rent increases as well as our occupancy. It's nice to say that you're getting 15% rent increases, but if you're bleeding occupancy through the back door, it's not, you're going to see this number start to tick down, and it's not going to be accretive. So we're really happy and really proud to see that this number continues to grow at a very expansive clip, both through accretive acquisitions as well as very strong same door revenue growth. So our same door, so assets defined as owned, but at the start of January 2021 have grown year over year in Q2 at a clip of 9.7%. So something that's very exciting to see, and then even better when we combine it with our NOI, or net operating income. Again, on the left-hand side, this is our total annualized quarterly run rate for our NOI, and we're seeing just an explosive growth as not only we've been acquiring at a strong clip, but also improving the performance of the assets that we've acquired, as well as the same-store performance. Year over year, we've almost doubled our annualized NOI within the organization, or within the CoreTrust product. And really, this is a product of very strong accretive acquisitions and same-store growth. So if we look at our chart on the right here, our NOI per own door, not only are we starting to see over the last year and a bit, some very, very expansive NOI growth. And that's due to that increasing NOI margin that you've seen, that as we continue to acquire assets and integrate them into the platform, we're spreading those costs over a larger asset base, as well as continuing to optimize our own operations, using our scale to get preferred pricing on supply chain side, ensuring that our expenses are reduced, as well as we're increasing the revenue that we saw on the past table there. So really over the last year, you're seeing that, we saw an increase in quarterly NOI of 35.5% year over year on a total basis, partly driven through our acquisitions and partly driven again through extremely strong same door performance of just under 20% year over year, which is pretty exciting to see. What does this all translate to? What this is translated to is very strong historical equity performance. What we're looking at here as the chart is our Class F product, where a hypothetical $100,000 invested into the inception of this product at the beginning of 2017 would now be, near the end of 2017, would now be $155,000. So we've seen historical, really strong growth. And really within the last 12, 24, and 36 months period, we've really started to see where all of that historical, operating performance, as well as some of those figures, really starting to come into play with double-digit returns, which is inclusive of our distribution yield, as well as some NAV appreciation. And what's really exciting to show is what we've highlighted here is our year-to-date number of 6.44%. We all know what's happened in the broader public and macro markets. So we've really been able to showcase, the point and the reason why individuals have alternative products within a portfolio. It's helping to differentiate and to really drive some uncorrelated returns. So we're very excited to see over the first half how strong of a performance we've been able to showcase throughout the equity for our funds here. I do want to mention here down below as well that we do have within this return, there is capital appreciation as well as we do have a targeted monthly distribution. Currently, that distribution yield is about 6.2%, depending on the unit class, and is also considered 100% return of capital. So a very tax efficient investment strategy. As our box shows below here, we do have a DRIP program that not everyone may be aware of, which offers investors a 2% discount on all of the reinvested units on a monthly basis, as well as to date, we have never missed a distribution payment and we have serviced all redemption requests in full and on time. And with that, I'd like to thank everyone for joining us today for what's really been an update on a very exciting first half of 2022. You've heard from Jason, you've heard from Anthony, all of the amazing things that's happening with Avenue, and then really you can really tell with them the excitement they have for what we're going to see over the next really 1 to 6 quarters that we've got very exciting plans happening here and what the future growth prospects for Avenue really are. We do continue to raise capital in order to continue to expand our operations, invest in our assets. Our next trade date is going to be on Monday, August 29th, and with a settlement date at the end of the month on the 31st. And with that, I'd like to leave everybody to their afternoon, and I hope everyone enjoys a fantastic rest of the summer. Thanks again.